Most people who start thinking about retirement investing eventually hit the same wall. They hear about the Roth IRA. They hear about the 401k. They read a few articles, watch a few videos, and walk away more confused than when they started. And the reason for that confusion is simple. Most of the content out there tells you what these accounts are, but nobody actually sits down and runs the real math to show you which one puts more money in your pocket over 30 years. That changes today because I did run that math. I ran it carefully, I ran it honestly, and I am going to show you exactly what I found. And I will tell you right now, the answer genuinely surprised me. Not because one account is dramatically better than the other in every situation, but because the answer completely depends on where you are in your financial life right now. And most people are making this decision without ever considering that crucial variable. Let me start by making sure we are both on the same page about what these two accounts actually are at their core, because the details matter enormously when you are talking about 30 years of compounding growth. A 401k is an employer-sponsored retirement account. You contribute money before it gets taxed, meaning your taxable income drops immediately in the year you contribute. Your investments grow tax-deferred inside the account, and when you retire and start withdrawing that money, you pay ordinary income taxes on those withdrawals. The benefit is immediate. You reduce your tax bill today. The cost is future. You pay taxes later when you withdraw. A Roth IRA works in the exact opposite direction. You contribute money that has already been taxed. There is no immediate tax break, but your investments grow inside the account, and qualified Roth IRA withdrawals are completely tax-free under current law, meaning withdrawals taken after age 59 and a half once the 5-year rule is satisfied. Two completely different philosophies about when you pay the government. And that single difference, when you pay taxes, is what drives everything else in this comparison. Now, here is the question that actually matters, and that almost nobody asks clearly enough. Which tax situation is better for you personally? Paying taxes now at your current rate, or paying taxes later at whatever rate applies when you retire? For many young workers in lower tax brackets, a Roth IRA is often the more attractive option because your tax rate now is likely lower than it may be later in your career and potentially during retirement. However, it is important to note this is not a universal rule. Someone expecting very low retirement income, someone pursuing early retirement strategies, or someone currently needing significant tax relief this year may find a traditional 401k more suitable. And it is also worth mentioning that higher income earners may face Roth IRA income limits that restrict direct contributions entirely. This is not a one-size-fits-all answer. This is a deeply personal calculation that depends on your current income, your expected future income, and your best estimate of what tax rates will look like decades from now. And I am going to walk you through all of it with real numbers so you can make this decision intelligently for your own situation. Let me run the numbers the way I actually think about this from an investing standpoint, because theory only takes you so far. Real math tells the real story. Let us take two investors. We will call them Alex and Jordan. Both are 25 years old. Both earn $60,000 per year. Both can afford to invest $6,000 annually toward retirement. To simplify this comparison, we are assuming both investors contribute the same nominal dollar amount regardless of the different tax treatment of each account. This example also excludes employer matching contributions, which we will cover separately. Both invest in the same broad market index fund, assuming an average long-term annual return of 8% annually, which is not guaranteed but reflects reasonable long-term historical averages. We are measuring account growth at age 65, which is a standard retirement age assumption. On the surface, the raw investment growth looks very similar. Both accounts accumulate substantial wealth over 40 years of compounding. The math inside the account is driven by the same return assumptions. The critical difference happens the moment they start making qualified withdrawals. Alex, with the traditional 401k, has accumulated a significant balance, but every dollar withdrawn in retirement is generally taxed as ordinary income. Assuming a 22% marginal federal tax bracket in retirement, which could be reasonable for some middle to upper income retirees depending on their total income sources, Alex pays meaningful taxes on every withdrawal, reducing the real after-tax value of that balance considerably. Jordan, with the Roth IRA, can take qualified withdrawals of the full accumulated balance completely tax-free under current tax rules. That difference in after-tax wealth is substantial and grows even larger the higher the retirement marginal tax rate becomes. However, here is one of the most important truths in retirement planning that financially savvy viewers already know. When tax rates are exactly equal at the time of contribution and at the time of withdrawal, a Roth IRA and a traditional 401k actually produce mathematically identical outcomes. The real advantage of the Roth IRA only emerges when your tax rate in retirement is higher than your tax rate when you originally contributed. And the real advantage of the traditional 401k only emerges when your retirement tax rate ends up lower than your contribution era tax rate. Everything in this comparison ultimately comes down to that single question about relative tax rates across time. Now, let me show you the scenario where the 401k clearly makes more sense. Take a senior software engineer or a corporate lawyer earning $250,000 per year and sitting in the 35% federal tax bracket. Every dollar they contribute to a 401k creates an immediate and significant tax savings today by shielding that income from a high current tax rate. If that same person contributes to a Roth IRA, instead, they are paying taxes at 35% right now, hoping that future tax rates will be lower in retirement. For high-income earners, the immediate tax savings of a 401k contribution is genuinely powerful and difficult for a Roth IRA to mathematically overcome unless future tax rates rise dramatically or the investor manages to keep retirement withdrawals in a meaningfully lower bracket. It is also worth noting that some employers now offer Roth 401k options, which combine the payroll contribution convenience of a 401k with the tax-free qualified withdrawal benefits of a Roth structure. If your employer offers a Roth 401k, this adds another layer of flexibility worth exploring. On the other hand, a 22-year-old making $45,000 per year and sitting in the 12% federal tax bracket has relatively little to gain from that immediate tax deduction. Paying taxes at 12% now to enjoy completely tax-free qualified withdrawals for 40 years is a compelling long-term trade-off for many people in that situation. And here is something genuinely sophisticated that most beginners never hear about. Many experienced investors intentionally build both Roth and traditional accounts simultaneously so they can strategically control their taxable income in retirement by choosing which account to draw from depending on their tax situation in any given year. That kind of tax diversification across account types is one of the most powerful and underappreciated retirement planning strategies available to ordinary investors. Here's the conclusion I want every person watching this video to walk away with clearly and permanently. The debate between Roth IRA and 401k is actually the wrong debate. The right question is not which one is better in isolation. The right question is, what is the optimal order of operations for maximizing your retirement wealth given your specific income situation right now? And after running these numbers carefully, a clear framework emerges that many financial planners recommend as a starting point for a broad range of young working Americans. Though individual circumstances always matter, and consulting a qualified advisor for your specific situation is always worthwhile. Step 1. If your employer offers a 401k match, contribute enough to capture every single dollar of that match before you do anything else. An employer match is essentially additional compensation your employer adds to your retirement account based on your own contributions. Missing out on your full employer match means leaving part of your compensation on the table entirely. This step applies regardless of whether you ultimately prefer a Roth IRA or traditional 401k for your additional savings. Capturing the full employer match should come first. Step 2. After capturing your full employer match, many planners suggest shifting your next contributions into a Roth IRA up to the annual contribution limit, which as of 2024 sits at $7,000 for individuals under 50. If you are young and in a lower tax bracket, this is where long-term tax-free qualified withdrawals can work powerfully in your favor over decades. Every dollar that goes into your Roth IRA during your 20s and early 30s has the longest possible runway for growth, leading to tax-free qualified withdrawals in retirement. Keep in mind, however, that Roth IRA contributions have income limits. Higher income earners above certain thresholds cannot contribute directly and may need to explore strategies like the backdoor Roth IRA conversion with guidance from a financial professional. Step 3. Once you have maxed out your Roth IRA contribution for the year, consider going back to your 401k and increasing contributions further if you have additional income available to invest. The 401k annual contribution limit as of 2024 is $23,000, which provides significant room for additional tax-advantaged investing beyond what your Roth IRA allows. By following this general order, employer match first, Roth IRA second, additional 401k third, you are systematically working to capture multiple tax advantages the retirement system offers. You are capturing the employer match. You are potentially building a source of tax-free qualified withdrawals during lower income years, and you are still reducing current taxable income through additional 401k contributions. This is a common framework many financial planners recommend as a starting point, though your personal situation, state taxes, income trajectory, and retirement goals should always guide your final decision. The final thing I want to leave you with is the single most important principle of retirement investing that nobody talks about enough. Consistency beats perfection every single time. I do not care whether the market is at an all-time high or in the middle of a 20% correction. I do not care whether the headlines are screaming about inflation, recession, geopolitical crisis, or interest rate changes. None of that matters as much as showing up every single month and contributing consistently to whichever combination of accounts makes sense for your situation. Wealth is not built through excitement or perfect timing. It is built through discipline, patience, and the simple act of showing up consistently for years. Both the Roth IRA and the 401k are powerful tools when used thoughtfully and consistently together. Understand your tax situation, follow a sensible order of operations, stay invested through volatility, and let time and compounding do the rest of the work quietly and powerfully over the coming decades. If you found this helpful, consider subscribing to Wealth Narrate for more simple, long-term investing insights. Drop a comment below with your current income, and I will personally tell you whether to prioritize the Roth IRA or the 401k first. See you in the next one.